Alright, y'all, so I just wanted to do a quick video recording of how I trade. I won't go to all the details, but we'll just kind of look at what I'm looking at, what I'm considering to enter a trade. So the main thing that I do is draw out support and resistance. So these horizontal lines on the chart represent either support or resistance. So if they're below the current price level, like these for example, these would be considered support levels. If the lines are drawn above the current price level, then these will be considered resistance. And so that's important because at support is where the buyers are, and so if the price falls to one of these levels, then you would expect the buyers to start buying up the stock, and you would anticipate a pivot to the upside. And just like you saw here, at resistance, you would expect sellers to be sitting there, and once the price level hits that level, you would see a reversal to the downside, just like you see in here. So when selling spreads, that's what I'm looking at. So I'm looking for a price increase to the upside, and when we get confirmation of resistance, then I'm looking to sell call spreads, because as this price is increasing, the value of the call premiums are also increasing. And so if we look at these call premiums, they're all increasing, 200, 300, 400% on up the chain. This is already set up for a vertical spread, which is what I typically sell. So selling call credit spreads where I receive a premium based on contract price and the number of contracts that I sell. So for example, if I were to sell this 420 call credit spread, then based on the current price, if I sell this right now, then I would expect to receive $255 times 100, so $258 per contract times the number of contracts that I sell, and I typically sell 5. So the thing that I usually look for is delta on these spreads, and I look for a delta of 0.16 or less. And so a delta of 0.16 is roughly equivalent to one standard deviation from the current price, which means that I have an 84% chance of this expiring worthless. So if you think of delta, that is the probability of expiring in the money. So the probability that the stock price will reach 405 in this case by the expiration date of August 6th. So there's a 16% chance that Zoom will reach 405 by this August 6th date, which means that there's an 84% chance that it won't. And since I'm selling these call spreads, then I want it to expire worthless, so I don't want the stock price to reach the strike price by expiration. If it doesn't, then I collect and keep that entire premium that I collected. So right now, I'll just watch what it does. So it's approaching this resistance level again, and we see these prices increasing. And so since I'm looking at the 16 delta, then that's the trade I plan to take. Once I confirm resistance and a pivot to the downside, then I take that trade. So now you see it's still approaching, and the reason why I wait is because if I enter the trade now and the stock price keeps moving through this resistance point, then I go negative on the trade, and so I'd be losing money, because remember I said as the stock price increases, so do the call premiums increase. And so if the stock price continues to increase after I enter the trade, then now it would cost me more to exit the trade than it did when I entered the trade, because the stock price moved up after I entered the trade. So I watch this level, and then if it starts to pivot to the downside, that's when I take the trade. Also note that as the, a lot of these values are fluid, they aren't static, and so as the stock price is increasing, so is the implied volatility in some cases, and then so is the delta. So if you just look, a minute ago, the 405 delta was 0.166, then it moved up to 0.18. Now it's dipping a little bit. So just by looking at that delta moving lower, if we look back at the chart, then I know that the price is decreasing from that resistance point. Well, it did, and then it sort of increased, but you see it's going from green to red, so it's kind of back and forth, but that's what you can expect when the price, the delta increased from 0.166 to 0.18. You know that that price increased a little bit. So now that this is coming back down, if we look back at delta, it should also be coming back down. It did from the 0.18 down to 0.17. So not changing a whole lot, but it is changing as that price fluctuates, as the stock price fluctuates. So normally what I do is just sit here, and then a lot of the time I would have my order ready to go. So I would be selling 5 contracts. So this is the net sell, and so I describe what a call credit spread is, or vertical spread is in the group. So with these, it's essentially going short on one call option and going long, so buying a call option as well, farther out of the money. So that's what the call credit spread is, and you collect a net premium, whatever price you get filled at times the number of contracts that you sell. Another thing that I also mentioned is that when you are selling credit spreads, the risk to reward ratio is going to be upside down, and so whenever you're selling, for the most part, this max loss, which is your risk, it's going to always be much higher than the profit that you can make on the trade. I'm not too concerned about the max loss because I manage my trades pretty closely, and so if the trade starts going against me, then I do what's called rolling out into a better position. So if I roll it out into a better position, then I collect even more premium than I could potentially collect on this trade, and so it sort of offsets the losses I might incur if I enter this trade and it goes against me. Selling spreads does require a lot of capital, especially if you're doing multiple contracts. And so it's something that you really want to make sure you got the appropriate buying power and the appropriate understanding of how selling premiums works. So I don't advise, selling 5 contracts, on your first call credit spread or your first put credit spread. Go slow, trade small, understand what it takes to enter the trade, understand how to exit, understand what the P&L looks like when you enter it, because all of the numbers are going to look different. So it's going to be a negative debit, which means you receive a credit, and so that's kind of confusing to people. So you can sort of see that here. So on Tesla spread, here's the market value. So the market value is negative, but that just means that's part of the credit you received initially. So on this spread, if you add these two numbers or the signs, that's what I received initially on the trade. And as the trade starts to move in your favor, whether it's a put spread or a call spread, then you start to see unrealized profit and loss until you exit the trade. And so here you see unrealized profit of $800, but on this Zoom call credit spread, which is similar strike prices that I'm looking at, but it's got a farther out expiration date of next Friday, currently negative, $225. That's mainly because if you sell a credit spread, then you want the stock price to move away from the strike. And so if the short strike on Zoom is 400, then you want the stock price to be moving away from 400. So anything less than that. But with today's price action, let's take a look. So on today, we've moved from 372-ish in pre-market all the way up to what we're currently trading at, 393. So that's a pretty big move. So I was initially up maybe $1,200 to open the trading day, and now it's down to $275. But again, it's still got quite a ways from my strike price, and so I don't get too concerned, because I know if I needed to, I can roll this trade out for larger credit that could make up even this $200 loss that is currently shown. So hopefully that helps. And so now again, I just sort of sit and watch the price action, and you also notice that these premiums are increasing. So for this 405 strike, as the stock prices increase, so too does the premiums. And so you also see what I mean by if I entered a trade here at resistance, I wanted to see the stock price pivot to the downside. But there were more buyers than sellers here at this level, and so you end up sort of blowing through that resistance level on up to the upside, a couple dollars higher. Then you just sort of watch and see what the price action does. You really want this to move opposite, especially on contracts that don't have a lot of time on them. And so I'm looking at this contracts that expire in 2 days, and so I just want to make sure I get the direction right, even though it's not really close to the current price. So there's still, what's that, 12 points between the current stock price and the strike price of 405. But my preference is to make sure that I confirm a resistance point, that it starts to pivot in the other direction, because now this, what once was resistance, it could be support. And so You may hit resistance a little higher and may bounce off of a new support level and then continue higher. And so I just want to be careful when I'm entering a trade, because I think entering the steps you take to dial in the entry is probably the most critical of all the steps you can take when you are selling options. And so you just want to take your time and make sure you dial that in appropriately. Choose the right strike, choose the right time of entry. Hopefully it does what you anticipate it doing, and then you can start profiting relatively quickly on the trade. So right now I'm just watching. It's look like, and what I use to assess, if I've got a resistance level, is if I see multiple candles attempting to test a certain level and fail, then that is a confirmation of resistance. So in this case, if I see multiple candles trying to break through this 393.60 area, then I'll just put a resistance line there and see what the price action does. If it tries to test it and fail, then it's probably a good time to take the trade. I'm also looking at the volume, and so you can see on some of these longer candles the volume is much higher, which indicates you've got a lot of buyers buying up the stock. And so on each successive candle, the volume sort of decreasing and decreasing, and so you would anticipate the stock fading a little bit. But all of these candles are closing green and not red, which is an indication of strength. So just watch it, and if any of these candles start to close red, then you would anticipate a pivot to the downside. So for now, I'll just stop talking, just watch, see what the price action does. If I go back over to the options chain, before I came back to the chart, I think the mid price was around 205. So I would anticipate that being much higher, a little bit higher than 205 at this point. Sure enough, it's 220, 225. So again, as the stock price increases, these call option premiums will move in the same direction, so they will increase as well. And by the way, just while we're here, so for the most part, in order to understand how much this premium increases, so for each $1 move in the stock price, then the premium increases by this delta. And so for each successive move of $1 move of the stock price, then gamma increases delta by this much. So $1.50. So each dollar that the stock price increases, gamma increases delta by this much. So hopefully that makes sense, but that just gives you an idea of what these Greeks are doing to the premium price relative to how the stock prices move. And so you see on this candle, it exceeded that resistance point up to a certain level, but then it faded back. So now we're turning red. Again, we want to see this candle, if it closes red, and then what the next candle does. And then that might be a good time to enter the trade. And so we're on the 5-minute time frame, and so each candle represents 5 minutes of price action, and you can follow that, with the timer on the chart. So we're at 11:44 now. So this current red candle should close in 55 seconds or so. So we'll watch it. And it's already starting to fade on this one, but again, you want to confirm that on the next candle. See if it's just a 5-minute pullback, or if it's no kidding going to be selling off. So we'll just watch this candle will close in 20 seconds and see what the next candle looks like. So you see the volume continues to decrease over time. But there's still some buyers there. Again, we look at these support and resistance level, and as I said earlier, what was once resistance could become support, and we're seeing that now here. So this candle closed, it tried to test this on the downside. She had buyers there buying up the stock again, and so the next candle, it's green and moving back up a little bit. And so all of this, we sort of call this consolidation. So this is kind of indecision. You've got buyers and sellers in this zone, sort of keeping the stock in this range. So we just continue to watch it and see what it does before we decide to buy or sell. In my case, sell any call credit spreads. Take a look at the 405 premiums now. Another thing, so we also see it coming down with the stock price decreasing. So it's going to moving back and forth. So if we go back, then that would indicate that the stock price is moving up a little bit. But also notice, this delta has also increased. So what was originally my target entry, I like to be, I said earlier, I like to be at 0.16 delta or less. So in this case, when the delta starts to increase above what my normal target is, then I might consider going one strike higher. So maybe the 410 strike price instead of 405. Give myself a little bit more wiggle room in case the stock price continues to move higher. Then it's got farther to go to reach my strike price, and I'm not at risk of losing on the trade. I'd be in a better sort of driver's seat, so to speak. So again, it's retesting that previous high. So we might draw another resistance line there and watch it. So you see why getting into the trade here would have been a bad idea, because now it's moved to the upside again, and I'd be down on that trade at this point. So we've got 25 seconds on this candle before it closes and the new candle opens. So we can just watch that. If it doesn't blow through this resistance point, then I might just go ahead and pull the trigger on this trade at the higher 410 strike price instead of 405. You know, choosing these strike prices, I just give you my thought process and my strategy. It's really kind of up to you in terms of how much risk you're willing to incur. The closer the strike price is to the current stock price, then obviously the more premium you're going to collect, but the more risk you're taking that the stock price could exceed that strike and be down on that trade. So I just like to give myself room and be a bit farther away from the current stock price so that I have a higher probability of winning the trade, even if it means collecting less premium than I probably could if I traded and take on more risk by choosing the closer strike. So on this new candle, it tried to break that resistance level, pull back a little bit. So we can probably see that better on the 1 minute candle. So you can see that easier here. So it broke that resistance level. Then on the next 1 minute candle, you see a red candle and it's starting to fade a little bit. So I use a trade either 1 minute and the 5 minute, and I just sort of look for confirmation. So if you're looking for more detail, then you can go down on the smaller time frames, like the 1 minute. Some brokers even have like seconds, 10-second chart, 15-second chart. But Webull doesn't. So the lowest it'll go is the 1 minute chart. But we're seeing, you know, this is a good indication of resistance. And so we also see the volume a little lower. You know, you prefer that to be a red candle, but it's green. It's not really moving up until it did. So, you know, don't be in a hurry. So if that's a lesson while we're watching this, don't be in a hurry to jump into a trade. Now it's turning red. So we'll watch it. As we gain more confidence in what the price action is doing, then we have more confidence in the strike price we choose in the trade we're about to take. So you can also look at this time to sell, so it shows the same information but just in numerical form. And so if I'm seeing red on the tape, then that is a sign of weakness, and so we would expect the price to decrease, or at least the candles to turn red and start to decrease. But we're still seeing, you know, a little bit of red, a little bit of green. And you also see there on the graphical, on the chart, on the candles, by hovering around that resistance point. And so it may break through, which means again that I just wait, because I'm looking for weakness, looking for it to hit resistance and start pivoting to the downside before I sell those call credit spreads at this level. So while we are being conservative and not in a rush to take a trade, Zoom is just picking up strength. So you see that here, these green candles are moving higher. You see the volume picking up in this area, and you also see a lot of green on the tape over here, which again would indicate that you've got a lot of buyers buying up the stock really at the ask price to a certain point, and then you'll see a pullback. So no need to rush. Just sit here and wait for confirmation on which way the stock's going to move. As it moves up, again, the premiums get higher. See here, premiums for each of these strikes actually get higher, and you see the percentage change on all of these is increasing. Delta has moved from that 0.179 back up to 0.186 or so. And so this is good because as a seller, you want to maximize premium at the strike that you choose. And so as the stock price moves up, you just sort of wait on it to stall out before you take the trade, collect more premium, then hopefully it starts to move in the other direction after you've entered the trade. So this is sort of called increased volatility. So in a higher volatility environment, the stock price is going to move up. These premiums are going to follow it. You collect more premium as a seller, but you just want to make sure you time your entry appropriately so that you don't enter at a level in the stock price way past you enter, because that means it's going to cost you more than what you collect premium to exit the trade, unless at some point after that the stock reverses down below your strike price, in which case you're in good shape. So mostly just sitting and waiting here, confirmation of when to enter the trade. Another thing you want to be mindful of is what's called a spread, and so that's the difference between the bid and the ask. So in most of these cases, we're looking at a 20 to 25 cent spread. Usually, you would like that to be a bit closer, in the order of a couple of pennies. Some stocks options may not trade that closely, so the spread may not be that narrow. So in that case, you've got to understand what it means in terms of your entry and your exit, more importantly, because if you try and exit prior to expiration, then it may be hard to exit the trade unless you adjust your price or closer to this ask. Otherwise, your orders might just sit there because because of the spread between what the buyers are trying to buy it at and what the sellers are trying to sell at. So if nobody's meeting in the middle, then no orders get filled. And so, but the tighter these values are between the bid and the ask, then the more liquidity there is and the more likelihood of you getting filled at the desired price. Still watching. So this is just sort of a good example of this stock just sort of stair-stepping up, and resistance levels become new support levels. So this candle closed at this new support level, the next candle opened, and now it's moving back up, and so we'll see if it exceeds the previous 5-minute candle. So we just sort of watch it. I don't want this video to become too long. Thought I was starting it pretty close to when I wanted to take the trade, but Zoom is not cooperating with me. So hopefully this is useful so far, describing what I'm looking for, what you should be looking for in terms of price action, volume, support and resistance, pre-planning which option you want to take, and being ready to pull the trigger at the appropriate time. So like I mentioned, I already plan to move my strike up to 410 so I can have that ready to go, collecting less premium. That's what happens the further out you move away from the current price, then the lower premium you collect, the lower premium, the max profit potential. But that's okay. So Webull, when you select the strike price, it will default to the midpoint price, but you can also adjust that up or down based on what you want to either pay if you're buying or collect if you're selling. So you can adjust that to what you want. So if I wanted to collect 160 per contract for a total of 800 bucks, then I could do that, and I could just place the order. Now the order might just sit there until the stock price moves up and the mid price is in that range. Or you could get somebody that just wants to buy the calls at that price, and they go ahead and fill that order. So go ahead and buy at 160, even if the mid price is less than that. So sometimes that happens too. So this is looking good. I still want to confirm what this candle might do. It looks like good resistance level in this 195 range. So I could take this, if I leave it at 160 right now, I'm unlikely to get filled. But if I change it to what the mid price is, then I stand a pretty good chance of getting filled. So now you see the reversal. Let's see if this takes. It may not take, because it moved pretty fast before I could sell it. So now you don't see that show up over here. You'll see the order just sort of sitting and waiting. So I'm asking for $1.52 per contract, or $152 per contract. Selling 5 of those. Let's look at this. So the mid price is lower than that. The best offer is 135. I'm asking for 152. So for right now, my order will just sit there, but that's okay. If I want to collect more premium, I'll have to sit there for a little while and see if somebody takes me up on that offer, or if the stock price increases, and naturally the bidders will be bidding more to get in on the trades. But you're seeing again here that, in a lot of cases, resistance can become support. If you're moving higher, support can become resistance if you're moving lower. And so understanding how to read the charts, understanding how to draw support and resistance becomes important no matter what you're doing, whether you are just buying and selling stocks directly, whether you are an options trader, whether you are a forex trader, crypto trader. It doesn't really matter. You can't really escape understanding how to read the charts if you want to be profitable consistently over time. So I recommend that as a starting point, no matter what instrument you trade. Get a good feel for how to read charts and how to draw support and resistance, and that'll go a long way in helping you stay away from bad trades and get into more suitable trades that will tend to in your favor most of the time. So you see my order still just sitting there. The bidders are at 130. I'm still at 152. So either people who want to buy these contracts will have to raise their bid, or I would have to lower my ask in order to get filled on these 5 contracts that I'm trying to sell. Otherwise, we get into just sort of a staring contest as long as the stock price is moving. Stock price starts to move up, and then you would see these bids get higher. These bids get higher and start to approach my sell price. then I'm more likely to get filled. So we might get a little bit more. So now we see this move up. We'll see if my order gets filled. And see if the bids increase at all. Not so much. There it is. So you see the bids just moved up. The mid price moved up. Still not quite there yet. So again, it requires a little patience. If you want to get filled at where you want to get filled at, then you wait for a little bit. Or if you're willing to accept less, then you can adjust your ask downward a little bit towards where the buyers are, which is at $1.40, $1.40. So looking at this, we've got one candle that closes red, another one with less volume and also closing red. And so that's an indication of weakness. So I might end up considering canceling this current order that isn't getting filled and adjusting it downwards, unless buyers start to buy this up a little bit. But it doesn't look like that's happening. So we're still the best price at the best ask. I'm sorry, best bid 40. I'm sitting at 152, and so you can feel that way. But this is the kind of chart you're looking for as a seller. We want candles to close red at the high and then start to fade, dip past these support levels. You're at least in decent shape and not seeing red unrealized P&L right away. So we want to see green unrealized P&L shortly after you enter the trade. And so it's still moving up. Still moving up. Let's see what the bidders are doing now. So this is still moving up a little bit. So is the mid price, but I'm still not getting filled. So if you look at this, so the last order that got filled was 57. So that might have been fewer than 5 contracts that I'm selling, and so that would get filled and mine wouldn't. So now this is starting to move beyond what I'm asking for, and so I might just cancel this order, because if I go back to the chart, I should see it up more. It's a little bit, but it's still, I'm still considering this area resistance. So instead of asking 152, I might ask, a little bit higher. And again, that order might sit there until these bids come up, but I'd be collecting more premium at the same strike price than I would if I had sold it a little bit earlier. So sometimes you'll notice that when you're trying to trade options is if the spread is somewhat wide, then exiting trades can be a little bit more difficult. Just something to be aware of, and just know that you might have to tweak your ask if you're selling, or tweak your bid if you're buying in order to get filled. So at that new level, still looking at 1, 2, 3, 4 candles testing that 95.75 level. Not able to break through, but slowly it's just they're stepping up a little bit more and more and more. So there's the resistance and fade a little bit. There is the corresponding lower volume relative to the previous candles. Should be seeing, in that case, red on the tape. Buyers are still in that same zone, so try and put the order in again, but it's unlikely to get filled in 5 contracts. And by the way, you want to get new to this, you want to double and triple check that you're entering the right values, that you are selling the leg that you want to sell, that you're buying the leg that you want to buy, and that you are setting up the right trade that you want to execute. So it's still moving up. So now you see the bidders are a bit higher now, right? So if you move this aside, the chart, again, we saw that low spot because I was trying to break through that level and go back a bit. Also notice these candles turn green, which means the buyers are overcoming the sellers at this point. My order. Oops, where did I go? So you gotta be careful with these windows and dragging them. Get into different places. You see how that changed. So you want to make sure, again, as things move around and you close and open windows, it goes back to the default quantity, which is 100. And I definitely don't want to sell 100 of these contracts. Don't have the buying power to do it anyway. So probably just reject it. But if you're opening and closing windows, just make sure the value that you want to enter in terms of price and the quantity and the legs that you're selling and buying of what you want. So let's see where we are here. Buyer's still at 145. See what this chart is doing. Still fading off of this resistance level, but these candles are going back and forth between green and red, and then the last couple are closing green, which means that the buyers are still relatively in control, even though there are fewer of them. So the volume in these two candles is still less than this red candle here. So on another screen, I did place the order. So my sell price is a little higher. Just sit there and leave it there and see what it does. But this is what I would normally look for if I were able to get filled. So shortly after I get filled, I'm looking for, a pivot to the downside, and I want it to keep going. But first things first, gotta get in the trade, and so buyer's at 140, which means 20-cent difference between what they're willing to pay and what I'm asking. And really we're talking about $100 if you think about it. So it's 20 cents, which is 20 times 100. 20 cents times 100, just $20 times 5 contracts, so that's $100 we're talking about. Is it worth sitting here waiting for an extra $100? You have to make that decision for yourself in terms of how much premium you want to collect versus getting in the trade sooner at the right time. So you may have to accept less to actually get in the trade. And that's because of the spread between the bid and the ask. It's 20 cents, so that makes it a little difficult to get your orders filled. I'm going to cancel this. Dipping even more, which means the bids are likely going to decrease even more, which means you as a seller would have to make a decision. Just wait, or do you meet the bidders where they are? Right, so now it's just moving down to 125. So my last ask was 160, and so that's just that order's going to get filled, so that's why I canceled it. But one thing to note is this looks like we are finding this consolidation area, and so 410 is probably a pretty good strike price if you can get filled. Because now it's starting to fade. And so that's the frustrating part, because had I gotten filled at 160 up here, I'd collect $160 times 5, which is, by my math, $800. And then as it starts to fade like it is, then I start to see green unrealized P&L. The value of these contracts will decrease as this stock price decreases, which means I could close these contracts for less than I receive. And the difference between what I receive and what I pay to close these contracts is what my profit is. But I didn't get filled, so I just get to sit and watch this stock price hit resistance, which is what we were looking for. So it tried, 1, 2, 3, 4, 5, 6 candles, failed to break through this level, and then it's starting to fade. So that's what you want to see. Confirmation of resistance. Have your strike ready to go. Understand the liquidity at that strike to see if you'll be able to actually enter the trade. Then you may have to adjust what you're asking for in the case of a seller. Otherwise your sell might just sit there like mine did, even though I was changing the ask upward. So the bidders never got that high, and so my order never got filled. So I eventually just canceled it. So you've got to strike balance between how much you want to receive and getting into the trade at the right time. So I had the right time at the right price, and so I didn't get filled and no trade. So I'm going to cut this off. I may make another video at some point that shows me actually getting into the trade, but at least this should be good to illustrate the thought process, the strategy for selling vertical spreads. So on selling call credit spreads, I look for price increase on the day. I look for confirmed resistance and a pivot to the downside. So you see the price increase from 272 all the way up to 396. It started to fade, so had I gotten into the trade here, I would have been in pretty good shape as it starts to die off, pivot to the downside, but couldn't get filled, and so that's always a potential, and especially if the spread between the bid and ask is significant, and so it's actually sort of increasing at this point. I think it was 20 cents earlier. So now it's going to bounce around. So that's that. Hope this is helpful. I'll show maybe the other side of this where you actually get filled and show how to close a trade. And that might be helpful for folks who are still trying to figure out how to trade options in general, to trade spreads as a seller. So I'll stop this for now. I hope this is helpful. Feel free to ask questions in the group Facebook pages. More than happy to answer any questions you might have. Thanks.